UK election day, so hopefully some of you would have already have cast your vote. If you haven't, obviously remember to do so when you leave. Polling booths close at 10 PM this evening, so you've got plenty of time. Make it count. But we're going to talk more about really other issues in this briefing this morning. We've talked about the UK election at length. I think most people are kind of up to speed with that. I did send out several pieces of research over the last couple of days about key constituencies to watch should we go into a period of monitoring the night, kind of stage by stage, if you like, if the exit polls are inconclusive. So you've pretty much got everything you need. It's just a matter of just making sure you're fully comfortable with all that material, and so any questions that you have, please feel free to come to me directly. So moving on then to what we've got this morning, looking at some of the other themes in the market. You can see by the charts I'm sharing with you at the moment, very quiet. It's kind of been a repetitive theme throughout this week, given the importance of today. We've obviously got the ECB, which we're going to talk about as well this morning. But a quick recap of some of the major moves from yesterday's session. And oil was an interesting one because we had a very aggressive move to the downside upon the release of one of the most one-dimensional, I think, reports we've seen in a while for the DOE infantry report. And this is kind of the one in, I would say, the 1 in 20 possibly that you get over a period of time, which is actually a little bit more easier to digest in terms of the information at hand. Now, as you know, the market always has this initial knee-jerk reaction to the headline. And yesterday we had a situation where the API headline, so the data which came out on Tuesday night, was indicative of a headline drawdown of around 4 million. And so when the market hears a build of just shy of 4 million, you're talking about an 8 million miss. So obviously in terms of market positioning, this couldn't be any more different. This is then that outlying scenario that you're looking for, given the fact that generally speaking the APIs and the DOEs tend to be quite highly correlated. This was a complete breakdown of that in one of those situations, so immediately it's a very strong sell signal. The biggest build in 3 months, in fact, for the headline. Then if you go through, aside from Cushing, gasoline, biggest build in 2 months, that was way above expectations. Distillates, the biggest build in 5 months. So it's one of those situations where the underlying data kind of fits with the overall headline, but the headline was so far away from what the market was expecting from the APIs, which had set the kind of precedence, if you like, that the market saw a very strong move on the downside. Looking at where we've kind of been and where we are at the moment, quite interesting, the move obviously that we've had in crude in really just the last month, the beginning of May to where we are in kind of early June. We've obviously had that point of which we saw a pretty quick collapse in price from mid-May or mid-April into early May on the back of just continuation of fears about US output and the speed in which it's increasing. Got all the way down to a point where we broke some levels we hadn't broken in a while, $45. That took us all the way down to a brief test around 44. Before then we had that intervention, if you like, from OPEC and non-OPEC nations. Don't forget the OPEC meeting didn't really happen until right up here. So this entire movement that you saw in this gain from 44 really to 52 was all on the back of talk that they were going to do something. Then of course you had the actual meeting itself, where they came to an agreement, the extension, very well telegraphed by the kind of news agencies. And so 9-month extension, same size of cuts, and then it was to kind of buy the rumour, sell the fact type price action, really big selling pressure actually the very next day. And then since then we've just continued to decline, because if anything the dynamic hasn't really changed, and it's kind of OPEC kicking the can down the road a little bit, because ultimately what can they do? Either way, as we've discussed here before, the US will continue to raise output. and that will continue to put further pressure on OPEC and force them to take more action further down the line. And so the overall trend continues to be lower here since we hit that high point at 52. I definitely think that 52 is going to be very tough to break in the months ahead and for the rest of this year, really. It's going to be a pretty big level. But on the downside now is really what we're more interested in. And if we should move any lower, then obviously 45 psychologically, and then everyone will be watching that previous low down at 44 towards that area. If we were to get below there, then we're kind of looking at the levels that we were last trading. Well, we would be back at the time of the US election. You remember the whole kind of idea of this Trump trade and this fiscal boost. Obviously that would increase demand for energy products if the world's most powerful economy starts to outperform amid fiscal policy. That obviously helped on the demand side of the equation, oil to recover, and so we would have taken back all of that if we get back down to these lower levels again. Obviously the lower we go, as you know, the more likelihood there is for OPEC to start stepping in again. But I would say OPEC are probably slightly reluctant to get too vocal at this point, given it's only a couple of weeks ago that they made the decision. Don't forget, this should take them all the way through to pretty much this time kind of next year, the current agreement. So they don't want to be firing kind of all their bullets at this point, because then they've got nowhere else to turn. One quickly on this point of oil and certainly geopolitics to be aware of. A couple of things. First of all, you could have missed it, because if you turn back the clocks only about, I would say, 2 months ago, the world was panicking that World War III was knocking on the door. This was after the US ordered very quick action airstrikes in Syria. This was going with, or alongside, increased tensions in the Korean Peninsula, and talk of North Korea firing missiles then was a big factor for some of the flight to quality bids, underpinned a lot of the rise in gold we saw at the time. So what we're looking at here is overnight North Korea have fired a suspected land-to-ship missile as South Korea delays the THAAD. So these things are still ongoing. They've not gone away. North Korea is being as confrontational as ever, and yet the market seemingly is disinterested at this point. Could be really two things. I think one, the market is desensitized given the regularity of these now aggressive actions that North Korea are taking. It's kind of the new norm. And then secondly, this is one of those things where if you're new to the market, you might think that, why isn't the financial markets able to focus on multiple different events ongoing at the same time? But what you need to understand is that the markets are driven by us as humans who are investing in it, whether we're buying or selling. And what we tend to do is we gravitate towards big events, and we solely focused, almost blinkered really, on one big event at a time that really dictates the kind of global macro driver at that point. And at this point in time, certainly on a day like today, it's all about the UK election. And then a footnote is the ECB as well. And then even below there, if you were going to layer it in, it's James Comey and the testimony in the Senate later this afternoon. But these other subjects certainly haven't gone away. And if, let's say, it is, as the market has positioned itself, a Tory majority, then we kind of move on to the next phase, if you like. And if the ECB goes to status quo, make very subtle small changes, then again, that kind of moves on and that goes away at least for another couple of months. But things like this certainly can come back quite quickly, is the point I'm making. So I would definitely be aware of these things that are ongoing. But again, it's more about the hierarchy of where it sits on the kind of agenda of financial market attention at this point, of which this is pretty low ranking. The reason why I'm pointing this out is because yesterday you also had this, which is Iran's Revolutionary Guards have blamed Saudi Arabia for the Tehran attacks. So Iran yesterday blaming the terror attack in Tehran on Saudi Arabia and vowed to take revenge, while the UAE government warned of possible economic embargo on Qatar should the Gulf state not change its course. Obviously this comes about a week ago, or at the beginning of the week, when you've had Saudi Arabia led with other nations like Egypt and so on, which have cut ties with Qatar because of Qatar's relationship, they say, with sponsoring terrorism, with the connection with Iran. There is a little bit of a side story going on here in the Gulf, and obviously Trump is probably not helping the peaceful situation that was, if anything, in play. He's almost stirred the pot with his international tour. I'm sure the guy to the left of me, Safe, would have a few things to say about, as he calls him, Donald J. Trump. But this, again, could quickly flare up quite significantly, and if that does, then that could be one of the only things that could see oil really counter this losing battle that OPEC are fighting amid ongoing oversupplied nature of the market, with US and Russian output being so high. I guess conspiracy theories, you could say that is this all part of the plan? Let's just create some destabilization in the Middle East to prop up oil prices. I think that's a bit of a stretch, but I'm sure some will connect the dots in that way. Okay, let's have a look then at a couple of other things that have happened. So that's the oil story. This was something which a lot of people have been waiting for today, but I would say this hearing, which is due to take place, I think it commences at 3 PM this afternoon, is turned into a bit of a non-event, because last night it got released was a kind of draft document, if you like, basically saying, in summary, what it is that James Comey's going to say today and what it is he's going to testify. And in summary, Trump asked for insurances on loyalty, so the sacked FBI director to testify that the president pressured him over Russia investigations. But in summary, the general feeling was that it failed to contain a smoking gun, and markets mostly ended up ignoring it. Comey confirmed that he did not understand the president to be talking about the broader investigation into Russia or possible links to the campaign when Trump persistently asked him for loyalty. I'm not sure how much I believe that, but it is what it is, and I would say that given this risk associated with Comey coming forward with new evidence that would be negative against the president and the administration and their relationship with Russia, that risk has sharply dissipated. And as such, I think that this testimony today is largely a non-event. Hence the reason why, if you look at the US equity market over the last kind of 12 or 24 hours, we've had a bit of a dip, sure. Oil inventory numbers certainly didn't help, weighed on the energy sector, but the fact that this report came out late last night saw Wall Street recover, and if anything, we're still within striking distance of all-time highs. You know, we're still up there at these very high valuations in the US equity market. So fears about Trump and impeachment, all those kinds of ideas which were circulating just a few weeks ago, I really don't think this Comey testimony today is going to be that big a deal, not given the news that came out last night. Okay, quick summary with the UK election. Again, as I said, I'm not going to talk about it too much, but really this is an interesting graphic that I saw this morning, and it was talking about the exit poll. How credible are they? Can we trust them? And statistically, there was a stat that I saw here. At no point in the past quarter of a century has the largest party's seat total been wrong by more than 15 seats from what the exit polls have told us. So just to recap, refresh you, Ipsos Mori, they're going to be releasing an official exit poll which will be released and run immediately by BBC News and Sky News at exactly 10 PM. They will give a seat projection. So this isn't just a percentage, this is an actual seat projection. At that point you will know pretty much, are we in for a kind of landslide Tory majority as what we similar fashion to 2015, or is it that close we then need to go in the process of mapping out all the different constituencies and trading it, the ebbs and flows of those results coming out. the one thing that's to be taken away here is the reason why there could be a very sharp movement at that point is because exit polls are usually right. They're highly accurate as to what the 10 p.m. projection, as you can see here, the darker shade, and the eventual result. As you can see, the last 2015, the projection had a majority to Conservatives, but it even underestimated that at the time. So they're going to be really critical. Okay, let's move on then, have a quick chat about the ECB. We'll talk about this again in more detail closer toward the time. Of course, we have the interest rate decision, 12:45, followed by the press conference, and this time forecasts as well, coming at 1:30 when Draghi speaks. Interest rate decision at 12:45, completely a non-event. It's not what we're monitoring today from the ECB. It's not about actual changes in policy. This is all about the communication, so we're going to have to wait for the press conference. So 1:30, typically it lasts for about an hour, to 2:30 is really key. So a couple of themes that we're looking at here. Watching the words carefully. And so we've got to a point where we've seen some fairly consistent economic improvement in terms of conditions measured by things like the PMI, GDP performance by even some of the southern European states such as Italy have improved. However, inflation has tailed off after a slight move higher that was seen just a month or so ago. And so watching wordplay is going to be particularly important as to ascertain what it is on the timeline that the ECB will look to come out of such a loose, accommodative monetary policy. So changing the narrative, as you can see here, will be particularly key. The ECB's hawkish camp has argued that the Council should tweak its language on the Eurozone's economic outlook. Now, this is particularly interesting because, okay, that's fine. So what is it, the exact words that the ECB are likely to say to indicate then of a change in stance? Now, first of all, how do you get to a point where you know that one word either added, removed, or altered is enough to make a tradable decision? Well, I'd say for the newer guys, it's going to take you a bit of time until you get to that point, because one, you need to have a very thorough understanding of ECB monetary policy. Two, you need to know pretty much verbatim what it is of the main structure of their last statement that they made, i.e. their current policy stance. And three, you need to be fully up to speed with what is it that all of the ECB officials have been telling you via speeches that have come out between the last meeting and this one. And then really fourth, trading the news, as you know, is difficult and really meant for when you've accumulated more experience, because you have to take decisions with complete conviction in very tight time frames, which comes obviously with an equal amount of higher risk. And so understanding these events, watching the ECB, for a lot of the new traders, this is about watching the market, the way it moves, the way that different assets like bunds might react differently to the euro, or the size of the move that's seen in the DAX, and then putting all the different pieces of the puzzle together so that over time you can then start trading these events as you get more confident. Because trading these types of quick, fast money moves is all about confidence and conviction when you're doing it, because speed is critical. So looking at these actual words, one of the key areas here, this is the head economist at Pictet Asset Management, and he always does this table every month. It's always a really good report that he puts out. And there's two real key areas we're looking at, or three actually, with the ECB today. The balance of risks. This is the big one that everyone's talking about, and this is Eurozone growth. And what we look at here is on the left-hand side, this is the current communication, this is the current language that the ECB are using. And this is the expectations of how it might change. And so at the moment, they qualify growth as the risks while moving towards a more balanced configuration, and this is the important part, they said are still tilted to the downside. So it's this particular wording at the end, the downside. Now, what we're anticipating here is that downside risks remain related to global factors, but this is the key change. But the overall balance of risks is now broadly balanced. And it's this broadly balanced which would be an upgrade to their economic outlook on growth. That on its own would be seen as a hawkish development, i.e., let's say the pendulum is this dovish, we're moving slightly more to becoming out of that stance. This isn't going all out hawkish, so to speak, but it's certainly moving in that direction. The next thing then is the communication about actual policy rates. So the current communication, policy rates to remain at present or lower levels for an extended period of time and well past the horizon of net asset purchases. So i.e. rates are going to remain low way after they finished QE and tapering of QE. So we've got basically a low interest rate environment for a considerable long period of time. Expectations then, policy rates to remain at present levels for an extended period of time and past the horizon of net asset purchases. So you can see it's just the removal of a couple of words is what's indicating this subtle change that the ECB are starting to make some steps towards the process of normalization. The other and third and final key area of the ECB today is going to be the star forecasts. Now let me just go back to the euro, because the euro and the DAX actually saw some really good movement yesterday on the back of exactly this third point. And that was because we had some source comments come out talking about this very matter. So if I just highlight that rectangle, that first box, there was a press report suggesting the ECB was preparing to cut its inflation forecast at the meeting today. There was a Bloomberg article claiming that projections will now be 1.5% for 2017, 2018 and 2019. Now, that was extremely dovish, because the current projections of inflation are 1.7 for 2017, 1.6 for 2018 and 1.7 for 2019. The Bloomberg source comments were essentially saying the ECB is going to downgrade that to 1.5%. One of the main reasons why central banks at the moment are looking to raise rates is because of the fear of inflation rising as economic growth starts to pick up. But what they're saying then is that this isn't the case, and actually we need to revise that down. That means more lower rates for longer, which is a very dovish way to interpret policy going forward if inflation just isn't there at this point. Really sharp move lower in the euro currency. What does this mean then? If ECB policy is kept very low and rate rising and tapering is pushed back to far out down the timeline, that's good for equities, lower interest rate environment, and so on and so forth. So the DAX rose, the euro fell in that instance. The interesting thing here, and this is something to take away from if you're trying to almost anticipate, you know, a lot of my job is about anticipating what the next news story might be, and then hopefully you can kind of get ahead and get a bit of an edge when the market moves on fundamental news, because you already kind of predict what type of news you're looking for, which means you can kind of get it quicker, or at least you can react quicker. One thing that always happens when news agencies release source comments, the first ones that came out we just discussed with dovish, and it moved the euro substantially lower. They came from Bloomberg. Now, I know from having friends who work at Bloomberg and Reuters, if Bloomberg snapped that comment and the euro just drops almost a point, then my friend who works at Reuters will be getting a very stern word in his ear from his boss going, "Why on earth have you not got this scoop? You need to go out there and get me a scoop." What typically happens then is that how are you going to move the market more? Well, if I just come out and say exactly what Bloomberg just said, the market's already had the move. Quite often what happens is the opposing news agency will come out, they will speak to their sources, but they will quite tactfully go to a source that they know is going to probably err on one side, and they'll come out and say the complete opposite. So what happens, the market is positioned on news story 1, news story 2 comes out, the rebuttal, and says the complete opposite, and we reverse. That is very commonplace, I'd say, in how the news agencies work. Don't forget, yes, they're here to communicate information. I'm sure that the ECB probably did genuinely leak a comment in order to take this euro a little bit in preparation for what I think will be actually a quite dovish event from the ECB. But Reuters came out, said the opposite, and we saw a move higher. When I said they said the opposite, the interesting thing here was that Reuters said ECB sources indicate that inflation forecast will drop, but what they said was that the drop would be small, indicative of 0.1%. Remember, we just said 1.7 to 1.6% is the 3-year forecast for inflation at the moment from the ECB, and Bloomberg was suggesting that there could be a 0.2 type drop in those years, whereas the Reuters story said only 0.1. This sounds very small, but actually, when you know what you're looking for, that's a big difference. And so then the market reversed completely on the back of that. So again, often a good way when you hear source comments, when I hear one and it's on Reuters or Bloomberg, I think in my head, when's the other competing news agency going to come out, and what are they going to say? Do they validate the rumor, or do they say the opposite? I would say on balance, from my experience, they usually say the opposite, because then they're validating their own service as a news agency. Okay, moving on, quick wrap up of some other headlines from this morning. Obviously we had German factory orders, was disappointing yesterday morning. However, German industrial production today came in at 0.8% month on month. That was above expectations. So industrial production strong, factory orders weak, net, no underlying real movement that's been seen in the euro currency this morning. Similarly, we've had some trade data coming out of China. Exports, imports surprise with a growth rebound in May. Again, hasn't really been too much ramification for the financial markets. No real distinct movement in FX in the Aussie, which is seen as the proxy for the Chinese economy. Quick look then at the calendar for today. To wrap things up, the morning is pretty quiet. You've got Eurozone GDP. These are Q1 readings. I would say the market is really not interested in that at all, particularly in the context of the ECB. ECB is really the big event today, because as far as the UK election is concerned, we're not really going to start looking at that until later on this evening. Now, I've tried to ask a couple of contacts about will we get any indications throughout the day about participation rates. Whether or not that's the case at this point, I cannot confirm. I'll do my best to see if I can get any concrete information, because participation rates for the UK election obviously will be key, particularly that younger demographic, which is where Labour's kind of ability to have any type of showing in this election is dependent on. Looking at the ECB again, 12:45, the rates part of the announcement is insignificant. It's the press conference at 1:30 that's important. We'll also get your weekly jobless claims, and then of course the exit polls start hitting at 10 PM. Comey, 3 o'clock, that's when he'll be testifying before the Senate Intelligence Committee. Okay guys, it's gone through 9 o'clock, so going to wrap it up there. Any questions, please let me know. Just be keeping an eye on cable here, just as I've been talking. Just got yesterday's high coming up at 129.84, which on the upside you've got 130.59. So market, as far as positioning here, still seems fairly comfortable that the Tories are going to get a majority. It being then, I'd keep an eye if we creep up to that high. Probably, I would imagine, provide resistance. I doubt people might want to push up to that point, but beyond there I think might be a little much without actually getting the exit poll itself. I'll just flip over my chart. At the same time though, the higher we go, should we get an inconclusive exit poll, then we're going to fall. The higher we are, the bigger we're going to fall. The more indicative it is of a hung parliament situation. And if we do get up to the 130, 130.50 or beyond, even before the actual event takes place, then all the more we have to come back down again in a negative situation. Don't forget, the night of the EU referendum, the pound traded a year-to-date high the moment the polling booths closed. and we all know what happened there. Well, on that doom and gloom note, good luck today, and I'll see you in the chat room. Thank you very much.